Okay, it gives me great pleasure now to bring on board Mr. V. Vaidyanathan, Managing Director and CEO with IDFC FIRST Bank, to walk us through what transpired for the quarter gone by, what should we expect for FY22, what is his understanding of the COVID provisioning and growth is. Mr. Vaidyanathan, good morning. Thank you for joining us. Let's spend some time trying to understand that the headline numbers don't look impressive. What is the inside story? Why is that there is a significant drop in the profits and there is an uptick in the NPAs?
Actually, it's very simple. First of all, let me just explain why this quarter provisions for the bank was so high. This is one question everyone is asking. So thank you for asking the question right straightforward. Now, last quarter, for 2 months out of 3 months, basically there were lockdowns. So the nature of our business is that the customers who do not pay in a particular bucket, they tend to move to the next stage of delinquency. People who don't pay that move to the next stage of delinquency. So that's what played out. Now, we have a very formula-based provisioning policy. Our formula is very upfronted meaning we recognize our provisioning policy losses very early. And because of that, because it's plain formula-based, our first quarter provision numbers came rather high, which you saw in the numbers. Our understanding is based on our formula about how we know our formula under whom we take provisions. Our second quarter provisions will be much lesser than the first quarter. A third quarter provisions will be even lesser than second quarter, and a fourth quarter provisions will be even lesser than first quarter. That's how our formula plays out. So basically, I understand the concern, but every quarter it could come down. And meanwhile, if you see the story for the last 2.5 years, the core operating profit has been going up really one way up. It's already, we touched the highest ever core pre-provisioning operating profit this year at 600 crores. So if that number 600 crores moves up, provisions comes down, which is what we're expecting, you will see that the profit jaw will automatically open over the next 3 quarters again.
Okay. When you look at the COVID provisioning, do you think you've been very aggressive in the entire COVID provisioning, whether it was last quarter or the current quarters before? I'm just trying to understand the whole approach.
Yes. See, the approach is that we have a very stage-wise, like I told you. We have a formula, we follow the formula. Well, the formula is kind of aggressive. You can call it conservative, actually, the correct word. It's rather conservative, meaning it recognizes it early, but then recognizes it early and later you will have lesser. That's the formula we follow. And it's been a formula we follow for a while. The key thing in retail, which is really important to note, is that if you walk back in time, we had an exposure to Dewan Housing, we had an exposure to Reliance Capital, and large exposures. But when we lost the money, we lost it for good. We never got the money back, meaning we got only 25 cents to a dollar. But in retail customers, just because we have taken a provision doesn't mean customer won't pay. Customer still owes us the money. So when the economy revives, these customers tend to pay back. Our experience is that even after provisions, quarter on quarter for years to come, money continues to come back. So yes, it has been rather early stage recognition, so to say, but we think money will come back. And we say good push.
So what would you say has happened to the recovery in the first 2 months of this quarter? Because what we are discussing essentially are numbers till June. Now we are in August. So for the first, not 2 months, but for the first 1 month of this quarter.
No, actually not just first 1 month. From the 15th of June to the end of June, we have that data point. And since we have declared the results a good 1 month after the quarter closed, we have the full numbers for July. So let me share with you July numbers. One of the key things we have noted is as follows. When wave 1 ended, somewhere, let me say, September of 20 or so, then every month after that, recovery kept going up. And by March 2021, our recovery crossed 100% of pre-COVID, as if COVID never happened. Pre-COVID, that is March 20, full 100%. Now, after wave 2 ended, so to say in June, lockdowns ended. Now in July, our collections have crossed 100% of pre-COVID numbers. So when we say our provision requirement will come down quarter on quarter, it is not just a hope. It is based on these numbers. So let me just, the straight answer is our collection is like 99.5% of the earliest bucket, what we call in our internal term, we call it the X bucket, early bucket. So that is crossed like, 99.5%, and we're feeling good about that. So basically, investors or customers shouldn't get very worried about this, because this is on its way down, and you will see it in the next 3 quarters. I'm on record on this on your show today, Nikunj, and you can keep this on record.
Okay, so what happens to your credit cost then, given that the last quarter, in a sense, has changed everything?
Yes, our credit cost. See, last quarter we have taken a provision of 1,800 crores. Needless to say, it has been accounted for early, so to say, and that was a formula. Now, our credit cost guidance for this year is ballpark about 3,000 crores. On an average loan book, we are expecting for this year of about 1,22,000 crores. So 3,000 on 1,22,000 works out about 2.5%. Our belief is, frankly, for a business like ours, which yields us upwards of 14%, to have a 2.5% credit loss, that too in a COVID year when wave 1 knockdown effect is still coming, wave 2 effect is really there, to get 2.5%, I think talks really well of a portfolio. And in fact, our guidance, again, is that for the next year, as the portfolio matures, based on the flow we see in our books and all that, we see 2% is our guidance for credit cost on a sustainable basis.
Okay. When a bank goes through a complete change because of external factors, COVID is external factor, how do you deal with that? Does it, do you take immediate steps to go easy on your investment? We've spoken about, you've been trying to build a digital infrastructure. Would you be forced now not to allocate capital there? Could this compromise future growth? Could this compromise future technology needs?
See, we should I have seen many cycles in my life, as I've been around for over 25 years in this industry. Cycles always come, and some problems come. In 2016 there was demonetization. In 2007 there was demonetization, felt like everything was collapsing around. Then there was GST. Then there is COVID. Now, just seen so many cycles. We should not alter our longer term picture on the basis of one event coming our way. We should just strengthen, learn, and keep moving on. So my short answer to that is that we will continue to stay focused on the big story. We believe that for a loan book that has grown from 94 crores to 30,000 crores till merger, now it is 75,000 crores. With the Indian story coming out, it can be 2 lakh crore, 5 lakh crore, 10 lakh crore. It could be anything in our lifetimes. But as long as we're stable about the strategy, I believe it's a mega bank coming up as far as our bank is concerned, and this can't be stopped.
Okay. I'm getting very different sound bites of where the retail book is headed, and I'm looking at your peers, companies or banks in this case, who've declared their numbers. Why is that we are not getting any clear messaging from, let's say, on the retail book? I mean, is there confusion? Is there because of different clients which every bank has?
You see, the NPA of most banks who have reported in the Indian market today, everybody on the retail side has reported higher credit losses, higher NPA, everything. So typically you find in the retail side, people have reported between 4% to 7% gross NPA and net NPA, depending on the provisioning policies. Now, my sense is that, when you're in the midst of a wave, then you tend to be a little muddled about this and you don't know where this game is headed. But I've seen enough cycles to note that on a stable state basis, an auto loan business, a new auto loan business gives about 0.5% credit loss. If you do a credit card business, probably it is 3 or 4%. If you do a two-wheeler business, probably like 3%. If you do a consumer durable business, probably like 5%. If you do a personal loan business, probably like 2%. If you do a home loan business, practically no losses. We may call it 1 or maybe 0.1% or so. So this is a broad mix that follow. I think that is once the COVID wave passes, that mix I think will roughly hold up. I honestly I don't think there's a real underlying issue in retail at all. It just plays out over cycles.
So let me address three important verticals for for your bank. One is CV, second is MFI, second is SME, and third is MFI. And again, I'm looking at numbers which you've got, let's say, from an Bandhan and Ujjivan, and the comments which you've got from them. What is happening to the auto portfolio of various other banks and what Mahindra and Mahindra Financials has reported. Looks like there is stress in the verticals. What happens now? What happens to you? Because you do have presence in the SME space and the microfinance space and the auto space.
Okay, I'll tell you numbers if that helps you. So if you think of, we have three businesses we do in the vehicles finance, and frankly, it is the vehicles business that got affected more. And really, it has run very well for 8 or 10 years. COVID comes. So when commercial vehicle we do, and COVID comes and the truck's not flying, they don't have the money. So when it flies again, they'll pay you back. I start from that philosophy. So coming back to the point, so commercial vehicle does get affected. Our two-wheeler financing portfolio, remember actually it's more about what profile we're dealing with. In two-wheeler segment, we're dealing with a customer base that is relatively a lower income profile by definition. That's why they're buying two-wheelers. Otherwise, they're about cars. So the income profile is relatively weaker. So when crisis comes or when economy troubles, then two-wheeler financing takes a hit. Commercial vehicle, which is a livelihood financing, takes a hit. JLG business customers employ at the lower pyramid customers, they live by the day, so they get affected. But really, we should see this. But we should not change the strategy just because one wave came. And we should just improvise. So, for example, will you want to do JLG? By the way, we have a 6,700 crore JLG business. Are we affected? The answer is yes. Does it mean we lose confidence in JLG business? The answer is no. So it's like that. In two-wheeler business, we have some fantastic property. We've done it for 10 years. So we lose 3%, but we earn 20%. We're quite proud about that. So the story doesn't change. We just adjust to the situation and move along.
Okay. What happens to the schemes which you had launched? And there were unique schemes. You came up with a credit card scheme where the first credit card, where even if you are late on your credit card payment, the interest rates was significantly lower. Your saving rates were very high, and that was aimed largely to get CASA towards your franchise. Typically, when you are dealing with high NPA stress on your balance sheet, would you be actively pursuing a high CASA draw, or perhaps this low rate in terms of credit card, schemes?
See, the fact is that I always think about it like this. You say, look, we got one opportunity in our lifetime to build a great bank. One. So I, in any case, believe that these are rare opportunities that we get. Now, in this one opportunity in a lifetime, just build a really great bank where every one of our products should talk about our ethos. It's not for nothing that internally we tell our employees. We've made a new stamp these days, which you will see it someday, but certainly internally here. It's called ethical, transparent banking. We make a seal of it and give it to our employees. There is a reason. So we say every product we make, we say there should be something different about it, which is special for the customer. I'll give an example. Credit card, since you started, ticked off on that subject. Every time forever since 30 years, APR in the country is 40%. Now, we are saying a new bank, we have no baggage. We start at 9% to 36%. Everyone wins with our bank. When we start, fees, everybody bills customers a hell of a lot of fees in credit card business. I don't say they're doing the wrong thing. It's the model. But, we are telling customers before they go to the over the limit to say, listen, you already touch 80%, don't go there, otherwise I'll have to bill you fees. So these are like genuinely high quality approach we bring to this sector. Even on savings accounts, like since independence till today, almost every bank pays savings account on a quarterly basis. But the EMI, they take EMI on a monthly basis. We started this model of saying that we will pay it on a monthly basis. So I think we are very fetish about this idea. making something special.
Markets got excited when the new RBI rules or the definition came when it comes to holding and merger of bank with holding companies. How should one understand the way forward for IDFC Bank and IDFC merger?
The truth is that we haven't yet talked between the two institutions on whether how to go about this, because actually the RBI norms have not come. I think they've just permitted some small finance banks to apply. So we'll wait for the guidelines. I'm sure, at the appropriate time, the boards will talk about that.
24 months. If the merger goes through, what changes for shareholders? And if the merger does not go through, what changes for your shareholders?
You're running ahead, so really I can't comment on that at all.
No, I'm trying to build a scenario. Let's say for a shareholder of IDFC Bank Limited and for a shareholder of IDFC, there are two scenarios which we work with. One, the merger happens. Second, the merger does not happen. So what happens in both the scenario? I mean, independently, if these both franchise have to remain separate, then what happens?
No, I really can't comment. All I can say, because these are matters and we will have to talk about it when the guidelines come out and all that. But I can say that our bank is on a pretty steady path, and we're very, very proud about the way building the bank, and we're very proud about our unit economics. So just to jump back to the previous conversation, I'll come back to this question. Our borrowing rate is less than 5%. Our lending rate on retail is 14%. We make an incremental NIM of like 9.5%. So that is a fantastic model. It can keep going. Now, these shareholder issues we'll deal with, but at this point of time, we are more interested in building a great bank, and I think that story is rock steady.
What is your preparedness, God forbid, if there is a third wave?
Wave one came. It took I think most people bit like the black swan event, and actually the fact that lockdowns happened was the real black swan event. It's not really the COVID. Now, what we did at that point of time is that we quickly readjusted our credit criteria to adjust for COVID-affected industries, touch-based industries, the hotel, restaurant, or the kind of stuff that we were financing. Now, once we did that adjustment after COVID wave one, we have found something very interesting, and you should take note of this, really, that we have in the last 12 months post-COVID wave one, booked like something like about 35,000 crores. And when COVID wave two came, and the lockdown happened, the collection performance on the wave, on the book built in this period, did not get affected by COVID. So the short answer is that we made necessary changes to our model meaning credit criteria, and adjusted it for COVID sort of lockdown effects of touch-based industries, and we should be okay. I think that you should expect, and frankly, even if you notice, the impact of wave two was lesser than wave one. And the impact of wave three, if at all, will be hopefully even lesser than wave two. So we'll deal with it. I think our guidance of 2% credit loss for the next year on the average book, that's what I would hold.
And you feel that would stay even if, God forbid, there is a third wave? I'm just putting that caveat into place.
No, yes, of course, COVID wave 3, God knows if it comes and how big it will be and how much in the lockdown, etc. We'll have to play to the occasion. I really can't speculate. But I can say that if it's a benign wave, like how wave 2 was, or how maybe it's smaller than that, then all our numbers hold. And I can tell you that even for the last year, if you take for the 2021, if you take the credit loss that we took to the book, it compares pretty favorably for similar businesses. This year, we're guiding for 2.5%. I would say for the yield of, the yield that we get in this business, I think any banker would give a right arm and leg to get a yield of 14% and lose only 2%. So even for this year, 2.5%, I think is pretty, compares very well with the industry. I think for next year, guidance of 2% on a stable basis, I think again is a pretty good number, and we feel very confident about that. So the only thing is that all these numbers does not factor for that one telecom account, and that will play it as it comes.
And how exactly have you positioned that telecom account in your book? I mean, I'm just saying that as of now, we know that there is one telecom company where the AGR issue is not sorted. How have you really provided for that account in your balance sheet?
Right now, we have we have an exposure of 3,200 crores, and we have a provision of something like about 475 crores or 500 crores. You can call it about 15% of the total exposure, or you can call it 25% of the funded exposure. That's the provision we have. So frankly, at 25% of funded exposure, I think it's better provided than I think most people in the banking system would have provided for that account. Now, issue is not provision. Issue is that we got to wait for that event to play out and whether they pay. But we hope we really believe and hope that the entity stays in place. When we think of it, we say, listen, we have faced enough bullets in life. We faced Reliance, we faced Capital, we faced Divan, we faced infrastructure. This quarter we faced an account, Mumbai-based account of 860 crores. We've taken every hit, and we can take any hit in the future. Life will be fine because our incremental unit economics are fantastic. But the bigger issue, which I feel as more as a citizen, is that it will be real tragedy of this country if this country became if all of us, you and me, are to be beholden to two service providers and telecom. I hope and I think the government and the ecosystem will ensure there are more players.
Okay, closing comments. We spoke about this last time when we met, and this is about, you've explained it, but I want to revisit it because that's a question which keeps on coming, at least on my Twitter handle, on a social media platform, is that when markets realize that you're reducing your stake in your bank, and that's your personal stake, and at a time when the bank is going through a patchy, difficult patch because of COVID and transition, it just makes people wonder that what is your skin in the game?
So why do you mention that I bring down my stake? I still hold a substantial stake in the bank by my standards.
Well, consequently, where you've been selling shares and you've been bringing, you've been selling it for charity purposes, but I'm bringing this point out because this is a point which people often write to us seeking an answer, that what is the purpose of you selling few shares also over the quarters?
See, the fact is that I had contributed about 40 crores to charity at that point of time, and later 20 crores to a few other things. But subsequently, see, the fact is that my cash flow as a salary is enough to just meet my personal needs. I don't have any more savings than that. If anybody I want to support or help, I can only contribute my stock to them. So yeah, I mean, I know what you're referring to. Last quarter, I gave some stocks to a few people. So these are not. By the way, none of my contributions are for my personal take to myself. They never sale for myself, except the one which I did to square the loan in the COVID crisis. Ever, all my sale are for. I mean, you can call it gifting or sale, whatever the charity is for somebody else. I think it's just what do I do with all the wealth? It's just meant to go to whoever maybe where it's put to better use than my demat account. So nobody should read much into this. I tell you, it's just the way I live.
I mean, it's something which people ask us on our handles to reach out to you to understand your thought behind it. I'm glad we discussed it again and you frankly spoke about it. Really appreciate your time, Mr. Vaidyanathan. Stay safe and certainly hope to see much more of you going forward.
Thank you very much. I must point out to your viewers, who are concerned about our profitability, because we haven't talked about that. If you don't mind, I'll just make one comment on that. Is that because we are a DFI, and you raised this question earlier also in a different context. Because we're a DFI, we are carrying 27,000 crores of borrowings even now from the pre-merger days, or at where we're paying 8.5%. So that's the drag on the P&L. So that is why you find that our core pre-provision profit is relatively low. So if one credit loss comes, it shows in the P&L and all that. But once we pay off this debt and we replace it at less than 5%, you can see the margin of the bank sharply lifting. I want to leave you with that comment. So just in case.
Okay, thank you for that. And stay safe. And thank you for joining us on the show.
So much. It was a pleasure talking to you, Nikunj, and everybody at ET now.